Later this month, the capital gains tax in Canada is changing. Here's what you need to know. Hey guys, it's Adrian here, the Canadian in a t-shirt. And today, I'll break down how capital gains tax actually works and how these changes will affect you. There's been a ton of confusion and misinformation on this topic, and frankly, the government's done a pretty awful job at communicating these changes. For me, I've got mixed feelings, but for this video, let's leave the politics out and just focus on facts and numbers. Let's start with the basics and some common misconceptions. A capital gain is whenever you sell an asset for a profit. It could be stocks, bonds, real estate, even a business. Let's say you buy a cottage for $400K. Years later, you sell it for $600K. You don't get taxed on the full $600K, only the profit, the $200K difference. That is your capital gain. And it gets better. You only pay taxes on half of that profit. That's the beauty of capital gains. It's literally twice as tax efficient as earning income from a job. That's because the inclusion rate, the amount you actually include in your taxable income, is only 50%. Now, on June 25th, this inclusion rate is increasing from 1/2 to 2/3. And this is where the misinformation begins. So, are Canadians now taxed at 67%? Absolutely not. The inclusion rate is 67% and only above a threshold of $250,000. Even if you're in the top tax bracket, earning $1 million a year, the maximum tax rate you will ever pay on capital gains is 35.7% in Ontario. No one is paying 67% in taxes. That's just false. And this tax increase doesn't apply to everyone. In fact, it won't affect the vast majority of Canadians. This tax increase only kicks in if you have capital gains above $250,000 in a single year. What if you're a doctor and you have a high salary of $400K? It still won't affect you. Your income doesn't matter, only the capital gains. So unless you have capital gains above $250,000, meaning you're selling around $500,000 worth of assets in a single year, these changes won't affect you. That's why some are calling it a wealth tax. This is important. This $250,000 threshold only applies to individuals, to people. For corporations and trusts, there's no threshold. All capital gains will now face this higher inclusion rate. But there's also some good news for corporations. I'll save that for the end. In this video, I want to focus on individuals. There are 40 million people in Canada and only 2 million corporations. So back to people. Again, these tax changes only affect you if you have capital gains above $250K in a single year. That's very rare. Here's why. Most people will never see a profit of $250,000 in a single year unless they sell real estate. So if you sell your home, will you be slapped with a giant tax bill? Nope. Selling your principal residence is tax exempt. You don't pay $1 in taxes when you sell the home that you live in. Even if your house grew by $1 million, you keep all that money tax-free. Now, if you have a second home, say a cottage or a rental property, yes, selling that will be taxed. And if that second property grew by more than $250K, then you will face this higher capital gains tax. But only on the amount above this threshold. The first $250K of profits will be taxed the same. I'll go through all the math with an example in just a minute. So unless you own multiple properties, this tax increase probably won't affect you. What about selling stocks? Well, it's very unlikely to trigger this new capital gains tax, unless you're fabulously wealthy. You would have to sell hundreds of thousands worth of stocks, all at a profit exceeding $250,000 and all in a single year. And it would have to be in a non-registered account. That's the only time you actually pay capital gains tax. Most Canadians invest in their TFSA, RRSP, RESP, the tax sheltered accounts. Capital gains don't even factor in there. You only pay capital gains tax when you sell a stock at a profit in a non-registered account. And it's still the most tax efficient form of income. So if you're worried about this tax hike, it's okay. You probably won't be affected. In fact, only 0.13% of Canadians will be affected, and only 12% of corporations. But I feel like this number doesn't tell the whole story. Yes, it's true that 99.87% of Canadians won't make $250K worth of capital gains this year or most years of their life, but it doesn't mean that they never will. There are millions of Canadians who own rental properties and cottages, and eventually they will sell and trigger this increased capital gains tax. So for me, yes, this tax change doesn't affect me, but eventually it will. I'm not complaining. Years down the line, if I sell a rental and make $250,000 in profits, I'm fine paying a little extra in taxes. That's a good problem to have. Let's talk numbers. Let's go through an example to see exactly how this capital gains tax works. To make the math easier, let's assume we were already at the highest tax bracket with a salary of $250,000. In the top tax bracket in Ontario, we have a marginal tax rate of 53.53%. That's how much tax we pay on every additional dollar we earn. Watch my previous videos to learn how tax brackets work. But real quick, let's say we got a huge promotion and now our salary increased by $300,000. When it comes to employment income, all that money gets fully taxed at our marginal tax rate. So 53.53% of that is $160,590 that we pay in taxes. That's a lot because we're in the highest tax bracket in this example, and income from a job is taxed the heaviest in Canada. Capital gains are taxed much less. Let's take a look. Let's say we bought a cottage for $400,000 and years later we sold it for $700,000. Our capital gain is the difference, $300,000. The current system has an inclusion rate of 50%, so only half of this profit is taxed. So our taxable gain is $150,000. We made $300K, but only $150K gets taxed at our marginal tax rate. Again, 53.53%. So we pay a total of $80,295. That's literally half the taxes we pay on capital gains versus a salary. Another way to look at it, the capital gains tax rate will be half the marginal tax rate. So 26.76% on a $300,000 profit. Starting June 25th, this is changing. Now only the first $250,000 of capital gains will have this 50% inclusion rate. So out of the first $250K, $125,000 will be taxable. Now there's the second step. The remaining capital gains, $50,000, will have a higher inclusion rate of 2/3. 66.7%. That gives us another $33,333 in taxable gains. So our total taxable income has increased to $158,333. Again, this amount gets taxed at our marginal tax rate, 53.53%, for a total tax bill of $84,755. So with this new tax increase, we're going to pay an extra $4,500 in taxes on a $300,000 profit. To be honest, that's not the end of the world. Of course, if our capital gains were even higher, then more of that income would be taxed at that higher inclusion rate, and this average tax rate would increase, but there's still a max. Remember, the first $250K of gains is taxed at 26.76%. Anything above that will be taxed at 35.7%. That's 2/3 times 53.53%. So even if you made $1 billion, the maximum capital gains tax rate would only be 35.7%. That's not a lot. That's a 9% increase. And even with these changes, capital gains are still the most tax efficient form of income, better than dividends and way better than employment income. Remember, if we made $300K in salary instead, all of it is taxable. We have a 100% inclusion rate. And you would essentially pay double in taxes for the same amount of income. So for those complaining that they no longer have an incentive to invest, capital gains are still the most favorable form of income, especially at those high tax brackets. And on the corporate side, yes, it sucks that all capital gains will be taxed heavier, regardless of your income. On the other hand, investment income has always been taxed heavier in a corporation versus the personal level, so that's nothing new. There's a lot to cover when it comes to corporate taxes. I'll make a separate video on that. But I will say this, I'm not happy with the fact that this new change will throw off tax integration for corporations. Tax integration means that no matter what you do, the total tax burden should stay the same. You can move money around with dividends so that the shareholder pays more taxes and the corporation pays less, or vice versa, but in the end, it should be balanced. But now, corporations will always pay higher taxes on capital gains, whereas individuals only pay higher above $250K. This throws off the balance, and now investing in a corporation is less favorable. Most people don't have corporations, so it won't affect you, but I'm curious what the government does to address this. On the positive side, they're increasing the lifetime capital gains exemption by 25%. That's a big boost to entrepreneurs like me. So now, if I were to sell my corporation for $2 million, the first $1.25 million would be tax-free. That's huge. Now, the remaining $750K would be taxed as capital gains. Here's the bottom line. If you're selling your business for less than $2.25 million, these changes will actually save you money. Your taxes go up, but the exemption goes up even more. There's also a new Canadian Entrepreneurs Incentive, which will further reduce capital gains when you sell your business. This incentive will be rolled out slowly, and I'll definitely make a video once we know more details. So with this big change happening on June 25th, what should you do? Should you sell your second property before this date? I would say no, not unless you were already planning on selling this summer. You don't want to rush and feel pressure to sell in a matter of weeks, especially in a down market. And remember, you don't pay any taxes until you sell, so why trigger that tax event if you don't have to? Stay calm, focus on the long term, and sell your investment when you want to, on your terms. And check out the rest of my Canadian tax guide, my videos with the silver thumbnails to learn more tax saving strategies. Thanks everyone, and I'll see you guys on the next episode of The Canadian in a T-Shirt. Bye guys!